morning, everyone in the crowd. On behalf of Kenanga Investors, thanks for sharing your Saturday with us. And thanks, of course, to the FSMOne team for inviting us. So my presentation will talk a little bit about the equity space. So, we've just come after, the fixed income expert. So unlike her, I can't really promise that, returns will be good for every year. Huh? But, I hope you do bear with us. I think the equity space is exciting and there tends to be, a lot of opportunities. But I think just to headline, to, set the stage, I think the title we use today is, investing in uncertain times. So uncertainty is, the key theme. There are still a lot of big picture items that I think, we still don't have a conclusive answer to. So, a lot of the investment strategies and, positioning needs to take that into account. I'll start it off with looking how have equities done year to date. If anyone has been paying attention to markets like the Nasdaq or maybe the Japanese Nikkei index, you'll see, performance has gone gangbusters this year. I think close to 30% return for the Nasdaq and the Nikkei respectively. But, why we say market performance has been mixed this year? I think, it's quite clearly there's only been a few teams that have been doing well. Even within the US, if you have a look at the Dow Jones, it's only done just under 4% in the first half. Such a stark difference versus the Nasdaq. And, quite unfortunately, where have the laggards been? It's mostly in Asia. Hong Kong, most of the ASEAN markets are laggards this year. Thailand, they still have a little bit of political uncertainty. I mean, even 2 months now after their elections, and they are probably the, the trailing market year to date. Unfortunately, Malaysia also not doing great. I think we are down almost 8% in the CI, but small cap stocks have done, a little bit more resilient. So what other things have moved this year? I think commodities on the whole have come off. Locally, we look at crude oil, CPO, both of these are down year to date. And the other thing is currencies. I think, the ringgit has depreciated. One of the worst in the region. I think it's down 6+% year to date. But, a lot of this is a factor of how strong the dollar has been. And I'll talk about some of the factors that have been driving this year to date. So, for the global outlook, we have to start with the US. I think, I don't want to echo too much of the previous presenters' points, but I think, the potential for recession is the key theme on most people's minds. I think, this is just a snapshot. The probability of recession, which is, an expectation of most of the street, is still above 60%. I think, to recap, this is not a normal figure. It seems like every few weeks, when we speak to economists, we get different views on when the timing of the recession could be, depending on, how strong the jobs data is, how strong industrial production is. It's been ranging from late this year to sometimes even early next year. But the fact is, they still expect some sort of slowdown to come. And, again, the divergence here is, as you've heard before, the job market in the US has been extremely strong. Wage growth has been strong. But at the same time, production has been coming off. Not just there, but as you'll see, in other parts of the world as well. So, how long can the strong factor offset the weak factor? To look at it simplistically, will determine how soon an actual slowdown will happen. I think this leads up to probably the most important theme that affects, markets for various securities. That is contrasting interest rates and inflation. Now, as you've heard, the US Federal Reserve had hiked, tremendously last year and just started to slow down this year. From the equities perspective, what we pay attention to, is not just the quantum, but I think expectations. Chart has fluctuated so much this year. So I think, that reflects in how equities have performed as well. So I know it's a little bit small and hard to see, but the point here being shown by the chart is the market still expects roughly 1 rate hike before end of the year. At the start of the year, this chart was showing up to 3 to 4 cuts. So I think, the change in expectation also reflects in how, the market either gets disappointed or, maybe their expectations are beaten when the Fed actually acts. So, right now, the Fed, after their recent pause, they were signaling up to 2 hikes end of this year. So if your question is, is there still room for disappointment? Technically, yes, if the market is only pricing in 1 cut. But besides that, how else can we predict what the outcome will be? Basically, inflation is your guide. As everyone points out, you can see a very nice sliding chart. Going down, inflation has fallen to 4%. But core inflation, as some people have pointed out, is basically been hovering near the current levels over the recent times. So it may indeed take an actual recession to pull inflation down to historical figures. Just to complete the global picture, I think to touch on Europe a little bit, their growth has been a little bit more shaky. They experienced a very large energy crisis last year, maybe they were impacted slightly more in terms of the banking and financial crisis. But what's happened this year is, the energy crisis was shrugged off, so the European markets has performed extremely well. But at the same time, you do see the same dynamics there as the US, which is, tightening is still on the minds of their monetary bodies. I think you've seen a lot of hikes from the ECB, and like the US, they are projecting roughly 2 more hikes before end of this year. And another thing we do watch out is for the Europe PMI. So this is Purchasing Managers Index. Again, just indicating the divergence between manufacturing and services. So you do see a little bit of a gap. Again, this is something we see, across most markets right now. Okay, and to round up the global picture, we have to go to China. So now, we talk again a lot about contrasting expectations and, what projections have been. At the start of the year, China was central body was talking about around 5% growth. By the start of the year, market expectations for GDP growth was actually as high as 6%. So, with the course of recent data, the market has been revising this down. So again, it's disappointment. And, that has weighed on the markets quite significantly. The positive point, I think, for most people when they think about China is what is the potential for more stimulus. We've started to see a little bit in terms of financial stimulus. So, the triple R rate has been cut, the loan prime rate has been cut. And this was actually out of expectations. Most people were expecting them to stay flat, even as the US and Europe continue to hike rates. But, basically the fact that these are moving tells us that they are aware of the risks of a slowdown in China. But, an additional note to this is when you have these contrasting factors with the developed markets hiking rates and China starting to cut, the natural outcome is the renminbi has weakened quite significantly. And in fact, when you talk about the ringgit weakness this year, people have started to notice, our correlation has been increasingly moving towards the movement of the Chinese yuan. So, if there is more weakness to come in the yuan, I think the unfortunate thing is, Malaysian ringgit may see more challenges still. Looking, a little bit deeper into, the Chinese economic data, I think, as Ms. Esther before me pointed out, at the start of the year, we were quite positive on, what seemed to be stabilizing indicators from Chinese data. I think a lot of rebounds were seen in various things, industrial production, FAI, which is fixed asset investment, and even like the property market, because that collapsed quite significantly in 2022. So while these this data has indeed stabilized at the start of this year, it's really not back to very large growth. We are starting to see low single-digit performance in some of these. But for us, I think the key uncertainty is actually in their external factor, which is the exports market. I think, people have noticed exports collapse quite a lot in May, and this has dragged exports performance, including in Malaysia. So I think, end of the day, this highlights, China is indeed the world's factory. And, if you do see, demand slow down in developed markets, it's a bit hard for the Chinese economy to avoid, some impact on their external sector. And, unlike the US or, even Malaysia, where, domestic consumption is like 2/3, 60, 70% of the economy, you have to keep in mind China's domestic consumption is less than 40%, showing how tight they are to global conditions. So, okay, I'll turn a little bit to the local market. Hopefully, there's a little bit optimism to be taken from here. I think just to sum up, the macro outlook for Malaysia is, on the most part, fine. Growth has been very strong. We have a little bit of a high base last year, but still, the headline figure is still expected to be 4 to 5%. Inflation has been coming off, like the rest of the world. Local jobs market is strong. Our interest rates have, in a sense, peaked. We had a surprise hike earlier in the year, but people are expecting BNM to kind of stay put from here on out. Where the challenges, again, where the uncertainty is the external segment. Our exports did dip in May, and as I've talked about, if the Chinese exports or Asian exports continue to dip, it's a little bit hard to avoid for Malaysia as well. And I think the last part that we can't avoid is there's always a little bit of a political uncertainty. I mean, it's in a sense not quite as bad as Thailand. So, our elections didn't take more than 2 months to settle. But, the local elections, state elections have again become an issue. So, while this is something maybe foreign investors don't quite pay attention to, it has been holding back sentiment on the ground here. So, I mean, we do have quite a few slides on the local macro, but I think, most of these I've kind of touched on. Growth is fine. Where there may be chance for a little bit of, sentiment change is in terms of subsidies. I think people were hoping for, some of the subsidies to be maintained. But from the federal perspective, they do want to trim the government spending deficit. So because of that, people have been thinking, when will the oil subsidy, the petrol subsidy be changed or removed even? So, this is something not likely to happen soon, but in a sense, it remains an overhang. Jobs have been strong, inflation has been good. These are the positive aspects I've talked about earlier. Exports, however, is probably where the challenge lies. Now, in the past, we may say that some of the challenge from exports is actually due to prices. At the very start, I talked about how, commodities have come off this year, palm oil have decreased. But the thing is, the recent, negative exports growth that we've had is not just in the, commodity sector. We've actually seen a little bit of slowdown in manufacturing goods. So, again, tying back to the picture where, global goods demand has slowed down, sometimes Malaysia will have to take that speed bump as well. And, just to go back on expectations, initially, the start of the year, the street was telling us exports probably will be flat or, maybe, experience no growth this year. People have rebased their expectations to negative growth. So for the ringgit, I think, the market is increasingly scared of giving a dollar to ringgit target. We've breached, historical low levels. We are quite near the 4.7 mark to the dollar. As I've talked about, I think it's hard to see us, kind of reversing course sharply as long as the yuan continues to weaken. And from China's perspective, if let's say they do see global demand slowing, it's actually in their interest to keep the yuan a little bit weak. So, that's one challenge we do face. But you look at the domestic fundamentals, things are fine. I think our BNM reserves continue to be quite strong, quite large. Our current account surplus remains positive. This means, as part of our normal imports and exports, the net demand for ringgit is actually still positive. So, what is happening is actually there's portfolio outflows. So I think, people have talked about how the, local equities have seen a lot of foreign selling. That's probably one of the bigger drags. Okay, now I'll talk a little bit about some of the themes where we see opportunities in the local market because, the macro kind of, it's kind of a straightforward picture from here. So, being a Chinese reopening beneficiary is a very consistent theme. Most particularly is in terms of travel and tourism. I've talked about, how maybe in terms of a manufacturing segment, that may be slow. But travel and tourism, Chinese tourists used to make up, low teens percentage of Malaysia, but they make an even larger percentage in terms of tourist spend. So, these are actual ringgit demand flows that can benefit us once this tourism flow comes back. Depending on who you speak to, they are surprised, the Chinese tourism has not rebounded as fast as we expected. But I think, the key thing to track is actually how fast the airlines resume their flights to China. So, when the capacity is only 20-30% of pre-COVID, of course, you can't have, that many tourists in person back here. So the good news is that percentage is actually starting to move up to the 60-70% mark by the end of this year. We can see this because, airlines have to book their landing slots and that sort of thing. So I think the Chinese reopening, travel tourism team will probably be a consistent performer as we start to see the improvement comes in the sequential periods. Infrastructure, this one is a little bit of a challenging theme because there's always a little bit of a link to how stable, the basically incumbent government is and their ability to dish out infrastructure projects. But nevertheless, I think, there's always still opportunities when it's relating to, let's say, MRT3 development or potentially, some of the newer works involving Penang. Energy sector reform. Okay, this one is one of those mega trend themes that we have seen a little bit of a slowdown over the last few years. What we mean by reform is basically the move towards more green energy. For those who tracked it, when we were back in 2018 with the new PH government at the time, there was a lot of focus on the RE or renewable energy team. They had very aggressive near-term targets, and there was a lot of money spent so that these infrastructures will be set up. Now, of course, it's slowed down, not just because of the political scenario, but also globally. Recall during COVID, we had like an energy crisis in several places of the world. So the focus became on energy security. So, it's not just nice to have, solar plants, being built. What they wanted was to make sure, we do have energy continuing. So, there was a lot of shift back to all these older energy sources, your oil, your coal, etc. So, now that, the COVID event has, with luck, passed already, we are starting to see a reversal of this theme. Interest is coming back to RE. People are starting to spend again to build up this capacity. And locally, I think the exciting thing is there's actually a lot of, government or fiscal effort to push this again. I think we've heard news that, they've extended the long-term RE target from 40 to 70% by 2050. It's far away, but, that's a big shift in terms of target. Then we've had other small things, like you may have heard this thing called the CGPP. It's a little bit complicated, but one of the themes is they encourage this virtual PPA program. So allowing a lot of corporates to engage in green energy generation plants to supply them, but not having it being close to their plant. To put it in simple terms, you don't have to be in a very precise location to start building up new RE facilities. And another new thing that is still in the very early stages is the potential export of RE energy. This one also I think has pretty large potential. I think all you have to do is check the average electricity tariffs between a country like Singapore and here, and you can see what the potential is if you can generate power here and sell it basically to foreign markets. The plantation sector is a little bit of a, kind of an underperformer for many years. I think, it's not really favored by a lot of investors. Everyone are familiar with the names, but one structural change I think that people should be watching out for is how weather patterns have changed. We've actually been in what they call a La Nina pattern for the past 3 years plus, which is, pretty unusual because the cycle typically takes 1 to 2 years in the past. But this extended period means that if we do go back into what they call El Nino, which is drier weather patterns here, especially in Malaysia and Indonesia, the large palm oil producers, you may again see a supply crunch, which in the past has always meant a good price reaction due to the reduced supply. And that has benefited some of the producers on a net basis, with the price factor offsetting potential volume losses. So I mean, not a super high conviction or structural story, but again, one of the factors I think we think is worth paying attention to. And I can't avoid talking about this. The tech sector is probably one of our long-term structural favorites. Now, what we have seen is the downturn in terms of global semis have actually started since the end of last year. But we only started to hear of this slowdown from the local companies at the start of this year. So again, that reminds us how far upstream Malaysia is in terms of the global tech or semi value chain. The good thing about that is that we do have a leading indicator. Most of the global players are starting to see a rebound as early as later this year. Some of that is helped by the AI team. So I mean, this team has been one of the bigger pushers of markets like the Nasdaq this year, where a lot of the mega cap or large companies have been starting to be seen as beneficiaries of the AI team. So the improvement or the recovery in demand means that we are probably quite near the bottom of the semi downturn, cyclical downturn this time round. So we have quite a good bit of heads up. Perhaps the local tech companies may take a little bit longer, again with that lag, to recover. But I think the outlook, when you look a little bit further ahead to 2024, I think has started to look a lot brighter. So earnings outlook, not much to say, but just want to touch on the foreign shareholding. We've dropped to, as people said, record bottom levels. We've gone below 20% as of June. Actually, this slide slightly outdated, and foreign outflows this year have been more than 4 billion ringgit. It's almost wiped out the net inflows we've seen last year. So when you talk about positioning in Malaysia, is there potential, for excitement? Let's say there is a structural story to be told. I think the potential is yes. It's basically still a little bit under-owned. And when you talk about valuations, there's no doubt Malaysia remains very cheap. For any foreign investors or even local, I think a stock picking or sector picking strategy tends to be easier in periods such as now, when valuations are quite low. Okay, I'll round it off with our strategy. So, this is probably the most important slide we have. Regionally, what are we thinking? I think the US, we've gone a little bit neutral. I think, you can see that there are a lot of, very large outperformers this year, especially those relating to AI. For those, I think valuations have gone, through the roof, very peakish instead. But on the other hand, we do have to weigh the risks of an emergent or potential recession come later this year or next year. So, on a broad basis, the US market is probably, in terms of risk reward, not as attractive as it was. So, again, to sum up, that's a little bit of a neutral take for us. Now, Chinese market, the China market, I think the strategy here is to be a little bit more selective. There are still a lot of opportunities, we think, especially those more related to the local, local market or based on domestic consumptions. Because I've talked about, most of the challenges they face are relating to the external sector. But for the local market, especially those where sectors are exposed to potential stimulus, I think this is where you can see a few more opportunities. Korea and Taiwan are markets that, these come and go with the tech cycle. And recently they've performed quite well, basically due to the AI factor that I've talked about. But they are still exposed to the potential rebound in the overall semi scene. And, when we talk about a potential rebound, this includes end demand, where, things like PCs, smartphones, all this are expected to decline this year, but make a rebound next year. So for some of these markets, I think the simple way to look at it is there's probably still legs to go. Looking at ASEAN, I think, this has been a bit of a challenging view to take because, everyone has been positive on Thailand since the start of the year, but it's underperformed, because of political uncertainty and of course, the not as fast recovery in China tourism that I've talked about. But, with the decline, I think the benefit is, again, valuations are looking attractive. A lot of the names exposed to these teams, which we believe are still coming, are still there. So, again, there's a potential for the Thailand market to outperform from here on out, despite the very weak first half. And to round up our view, which is on Malaysia, I think we can't help but say, we still expect volatility. I think, political uncertainty remains probably one of the bigger factors, where pulling people back. So because of that, on a timeline basis, all out, being increasing exposure right now is a little bit challenging. But beyond that, taking a slightly further view, I think there's still quite a number of themes we do like. Some of these I've talked about earlier. In general, what do we like is things exposed to still long-term structural trends. I think those especially relating to cycles, these we expect them to recover. In terms of more specific themes, I think the China reopening, which is travel and tourism, this is probably a decent option. Infrastructure project rollouts, we do see some tactical trading opportunities. I think on here I've talked about oil and gas, but this also refers to things like commodities, in particular palm oil, which I've talked about. High yields, in the past, people have talked about going after the high yield segment because it's a little bit more defensive. But actually, I think the position this time is, moving towards higher yielding counters actually benefits from a potential eventual cut in rates. So when the rate cycle starts to turn, actually high yielders are beneficiaries. And, to round it off, I think the growth mega trend sector, I think, it would be actually riskier to avoid this sector, especially if the turnaround may come as early as next year. I think, those relating to the tech and semi space, even those in renewable energy, and of course, those with, a little bit of an ESG story to tell, I think that also can see their valuations supported. And that rounds up what I have. Thank you very much. Yeah.